So most contractors don't realize this. You can do a completely legitimate equipment sale inside the family and still lose a $40,000 deduction without breaking a single rule. Today I'm going to explain the quiet IRS rule behind it and how to structure these deals the right way so you don't get blindsided later. So let's get started. So if you're a construction business owner, you might have equipment in multiple entities, have a spouse involved in ownership, have a partnership with your child, lease equipment to your own company, or sell assets between related companies. And that's exactly where Section 267 becomes dangerous. This rule doesn't care if the deal was fair or if it was at market value or had good intentions. It only cares about who you're related to. And if you cross the line, your deductions disappear. Section 267 has two big landmines, and one in particular which we'll be going over today. Number one, losses between related parties are disallowed. If you sell property at a loss to a related party, unfortunately that loss would not be deductible. So if you sell a skid steer worth $60,000, your tax basis is $100,000. So you take a $40,000 loss. But if the buyer is related to you, that $40,000 deduction could be gone. The IRS says the asset didn't really leave the economic family unit. But here's the twist. If the buyer later sells it to an unrelated third party at a gain, they can use that disallowed loss to offset their gain. But if they sell it at a loss, that original loss will be gone forever. So who counts as related? And this could get pretty dangerous. Under Section 267, related parties include your spouse, siblings including half-siblings, parents and grandparents, children and grandchildren, corporations you own more than 50%, partnerships you own more than 50%, trusts, and controlled corporate groups. But here's another trap, and that is constructive ownership. You may not think you own more than 50%, but the IRS might. So let's say you own 40% of your construction corporation, your wife owns 20%, and your daughter owns 10%. You're deemed to own 70% because family ownership is attributed to you. Now that you own more than 50%, you're considered related, and the loss will be disallowed. And if your partnership owns stock in your corporation, that ownership flows up to you proportionally. Here are some issues that I see in real life. Number one, selling equipment between entities. So if LLC 1 sells a backhoe to LLC 2, both owned by you and your spouse, that loss will be denied. Number two, moving real estate between family entities. So if you transfer property to your son's company below your tax basis, that loss will be denied. Number three, accrued management fees. Your S-Corp accrues payments to your spouse's LLC. The deduction will be denied until paid. This isn't to be doom and gloom about it all, it's just to tax plan properly. Here are some planning tips. First of all, identify related parties before the deal. Before you sell equipment, real estate, vehicles, shares, partnership interests, run your ownership through the attribution rules, the lists I mentioned earlier. Another strategy is to break attribution chains. So diluting ownership below 50%, using non-voting shares, or bringing in a legitimate third-party investor, these can prevent related party treatment. Number three, sell to unrelated parties if you want the loss. If you want the deduction, just sell outside the family group. And number four, make sure accounting methods match up. If one entity is on cash basis, the other one should be cash as well. So I hope you found this helpful. If any of this applies to you or you need help planning things around your specific situation, please feel free to book a time. Our calendar link is down in the show notes, and see you in the next one.